The US dollar and Treasury yields have long moved in tandem, reflecting investor confidence in America's economic stability. However, recent developments have disrupted this relationship, signaling potential shifts in global financial dynamics. In recent months, however, this reliable relationship has begun to crack, and not in a subtle way. Investors and analysts are now witnessing what many are calling a decoupling event. The US dollar is no longer moving in sync with long-term Treasury yields. That might sound technical, but its implications are vast. The dollar's behavior is becoming increasingly erratic when compared to the traditional bond market indicators. In other words, even as yields on long-term treasuries rise, suggesting investor demand for greater returns, the dollar isn't following suit. In some cases, it's even weakening. This contradiction is more than just an odd occurrence. It's a signal that the financial ground beneath our feet is shifting. So what's driving this divergence? First, the role of inflation expectations can't be ignored. With inflation cooling at a slower pace than anticipated, the bond market is pricing in future interest rate adjustments. But currency markets are reflecting a different sentiment altogether. Investors seem to be questioning the long-term health of the US economy and are less confident that rising yields represent strength. Instead, they interpret them as compensation for higher risk and uncertainty. Second, geopolitical instability has altered how markets respond to economic indicators. Tensions in Eastern Europe, uncertainty in the Indo-Pacific, and volatility in oil markets all contribute to a cautious investment climate. In this kind of global environment, the dollar is no longer viewed as the only safe haven. Currencies like the Swiss franc and even gold-backed financial products are gaining traction among institutions and retail investors alike. Third, central bank behavior worldwide has shifted dramatically. Nations that once held substantial amounts of US debt are now reducing their exposure. China, for example, has steadily decreased its holdings of US treasuries, a move that not only weakens demand for these bonds, but also casts doubt on the long-term desirability of the dollar as a reserve currency. Meanwhile, developing nations are exploring multi-currency frameworks for trade settlements, minimizing reliance on the dollar altogether. We also need to consider the role of institutional investors. Hedge funds, pension managers, and sovereign wealth funds are reallocating their portfolios in ways that deviate from historical norms. Historically, rising Treasury yields indicated a strengthening dollar, as higher returns attracted foreign investment. Conversely, falling yields often led to a weaker dollar. This correlation provided a predictable framework for investors. Yet, in recent months, this pattern has broken down. Several factors contribute to this decoupling. One significant element is the increasing skepticism about the US economy's resilience. Concerns over escalating national debt, trade tensions, and political uncertainties have led investors to reassess the dollar's reliability as a safe haven asset. Additionally, the Federal Reserve's monetary policies play a crucial role. While the Fed has raised interest rates to combat inflation, the dollar hasn't strengthened as expected. This anomaly suggests that other forces, such as global economic shifts and geopolitical tensions, are influencing currency valuations more than traditional monetary tools. Internationally, there's a growing trend of de-dollarization. Countries are seeking alternatives to the dollar for trade and reserves, aiming to reduce dependence on US financial systems. This movement further undermines the dollar's dominance and could have long-term implications for its value. Moreover, the global economic landscape is evolving. Emerging markets are gaining prominence, and alternative currencies are becoming more viable for international transactions. These changes challenge the dollar's supremacy and could lead to a more multipolar currency system. Investors must navigate this complex environment carefully. Diversifying portfolios and staying informed about global economic trends are essential strategies. Understanding the underlying causes of the dollar yield decoupling can help in making informed investment decisions. In conclusion, the traditional link between the US dollar and Treasury yields is weakening, reflecting broader shifts in the global economy. This decoupling underscores the need for investors to adapt to changing financial landscapes and reconsider long-held assumptions about currency and bond markets. If you found this analysis insightful, please subscribe to our channel for more updates on global financial trends. Share your thoughts in the comments below. How do you see these developments affecting your investment strategies?